I would like to just thank you all for attending. It's nice to have you all on this call. And as ever with our webinars, please do reach out with any comments and questions as we go through the chat box. And yeah, we can address those at the end, or we can pick up with any specific questions on a one-to-one basis if any do arise that requires a bit more in-depth discussion. So firstly, just by way of background, my name is Dominic, and I'm one of the tax directors here at Paye. I've got over 10 years experience advising high growth and entrepreneurial businesses. My background is generally within corporate advisory, previously working in Big Four and top 10 firms, specializes in international and transactional tax advice, including overseas expansion, reorganizations, acquisitions, and of course, innovations, incentive advice, including R&D and patent box. So I've worked with business owners, including venture capital backed startups, right from early stage tech companies through to FTSE 100 corporates. And now in terms of just a bit about Paye, for those that don't know us, we're a full service accountancy firm with also dedicated specialists across a number of areas, including our corporate finance team, which has a team of sort of really experienced ex-financiers, which give crucial insight into the mindset of lenders, and they've also really strong relationships with lenders to be able to help make good decisions around sort of funding and acquisition support. Our business services team is generally the day-to-day contact for clients. They cover everything from what you might expect in terms of audit and accounting and compliance, but also just on hand to help with preparing and planning for growth, looking at acquisitions or succession planning. Paye, as a business, has been established for over 90 years. We've got clients that range from early stage startups to large international groups. And our focus is on providing proactive, a value-added approach. So we're not just focused on providing the usual accountancy and tax compliance services, but being there to support and help your business grow for the long term. We're a partner-led organization, which means your day-to-day contact and key contacts within the business will be one of the partners, and we'll be there to provide the advice that you need. We work on a fixed fee basis. We'll agree fees up front, so you don't need to worry about what the clock's running out, whether you're going to be charged for picking up the phone or not. We like to make sure that you're getting value for the advice that we provide. So in terms of what we're looking at today, as the title of the webinar is around innovations incentives, we're going to have a brief look at what the R&D tax credit regime is, just as a very quick catch up, just for anyone who's not aware of the basics about what the regime is. We're then going to delve deeper into some of the key changes that have been announced over the past 12 months and how this might affect claims going forward. We're going to take a look at the Hmrc inquiry landscape, what this means for businesses making R&D tax credit claims, and the response that they can expect from Hmrc at the moment. And then going to move on just to touch on patent box, which some of you may or may not be familiar with. A lot of our clients are making R&D claims, but patent box is something that can sit alongside that and something that can provide very attractive tax benefits to businesses going forward. We will also be joined just at the end of the webinar by Lombard Financial Services. They'll be providing an overview of their IP funding product. So I'm joined by the relationship director there, who will cover off an interesting look on IP funding a little later in the webinar. So delving straight into it then, what are R&D tax credits, and what is the tax regime around incentivizing research and development? So in essence, there's two routes in which businesses can claim under. One's generally referred to as the SME scheme, and one's the large company scheme. The SME scheme is aimed at businesses with fewer than 500 staff and either not more than 100 million turnover or 86 million gross assets. So it's quite a high threshold, and most companies will generally fall into this category. The benefits to businesses are that if the SME is loss-making, they can effectively receive up to 33% of their investment into R&D back in the form of a payable credit. And for profit-making businesses, they get an additional benefit of 25% of what they invest into R&D. Under the large company scheme, it's slightly less attractive, but by no means not of value to companies. The RDEC scheme provides up to an 11% benefit for every pound that's spent on R&D, qualifying R&D expenditure. So I mentioned RDEC, whilst it's aimed at large companies, there is situations where an SME can fall within the RDEC regime, and this can be where the SME has been subcontracted to undertake R&D by another party. So this could be where it is receiving payment from a customer to undertake R&D on their behalf. It could be that they're receiving grant income, or it could be that the project's capped and there's a legislative cap on how much a certain project can claim under R&D. That's particularly high and not something that tends to come up too often. So looking just at how the two regimes work, both schemes are a government incentive designed to reward UK companies for investing in innovation. And they both work in a similar way, but have a slightly different outcome. So firstly, it involves looking at what the business has done in terms of R&D activity, what projects meet the definition of R&D activity, and then looking at the costs associated with undertaking that activity. Under the SME scheme, the benefit gives the company an additional deduction of 130% of their qualifying expenditure. Broadly, this means that if a company would spend £100 on qualifying R&D expenditure, they would effectively get tax relief on £230, or that £230 could then be surrendered for a 14.5% payable tax credit, which would in effect give them a £33 refund for every £100 that they spent on R&D. Under the RDEC scheme, the qualifying expenditure is calculated slightly differently. That there's some restrictions in terms of what costs can be claimed. So that restricts the overall cost base of the R&D claim. But what is left is then subject to a 13% above the line credit. So above the line, it essentially means that the credit is also treated as income subject to corporation tax. So the net benefit is then 11% corporation tax reduction for every £100 spent on qualifying R&D expenditure. So to qualify for R&D tax relief, the company must be a limited company and subject to UK corporation tax. And the company needs to be undertaking what's considered R&D for tax purposes. And this is defined as a project that seeks to achieve a scientific or technological advance. And whilst trying to achieve that scientific or technological advance, it needs to be resolving a scientific or technological uncertainty. And where a company is doing that and meets the eligibility criteria, it's then able to make an R&D claim in relation to its qualifying costs. The qualifying costs could then consist of subcontract payments. So this may be payments to other companies to undertake specific elements of R&D on your behalf. It can include software. It can include staff costs, which is generally the biggest cost category for most businesses, and consumable items used in the R&D process. As I mentioned before, the RDEC scheme is slightly more restrictive in that certain subcontractor costs can't be claimed under RDEC. So under RDEC, the only subcontractor payments are those made to qualifying bodies, which includes charitable and university organisations and partnerships made up of individuals, so not other companies, which can be quite a restrictive claim for for SMEs that are perhaps forced into the RDEC route due to being in receipt of effectively funded R&D. So just delving a bit deeper then into what is a scientific or technological advance. This is considered an overall expansion in knowledge or capability in the field of science and technology. And what it means by that is that this needs to sort of push the boundaries of what's already known, not just within your firm, but in the field in general. And this can lead to tangible outcomes, which is quite often the main outcome of an R&D, which is the creation of a new product or process. Or it can be intangible outcomes, such as knowledge increases or cost improvements. But the overall essence of this is to create a product, process, or service which incorporates an increase in knowledge or general capability within the field of science and technology, or make an appreciable improvement to existing products or processes or services. Then looking at what is the second eligibility test of resolving an uncertainty. This exists when a knowledge of whether something is scientifically possible or not is not readily available by a competent professional working in the field. And this is a really key point around claims at the moment, and what has come under scrutiny with Hmrc in a few cases is this concept of a competent professional. And those of you who are claiming R&D may have seen that in the R&D reports that we're preparing, there's an element where we disclose who is the competent professional within the business. And this is the person who has made the assessment of what is a qualifying project or not, and has gone through in determining the relevant cost categories and qualifying expenditure in relation to the projects that have been undertaken. And this is generally someone who leads the R&D process within a business. This is someone with sort of deep industry knowledge, or a scientific sector specialist within the field in which they're seeking to make an appreciable improvement. And so every claim should be supported by a competent professional who's made the judgment in terms of what is a qualifying claim or not. And they are then the person that's responsible for setting out why there's been a resolution of some uncertainty within the project, and what they were seeking to achieve within the project. Now, once a claim has been completed and prepared, an SME will essentially have four options in how to utilise its loss. So as we said, if a company spends £100 of qualifying R&D expenditure, they in essence get up to £230 in which they can utilise as an additional loss to the business. So if overall they are loss making, that whole £230 can be surrendered at a rate of 14.5% for an immediate cash repayment. And that's a unique relief for losses for our R&D claiming companies. So in other cases, if you just have an ordinary trading loss, that can't be surrendered for cash. This is just unique to those businesses that are undertaking R&D. However, with losses generally, businesses have other options in which they could utilise losses. So they could carry back the loss, including the enhanced expenditure, and offset that against previous trading profits, and then effectively get relief on that at 19%. If your R&D claimant company is part of a group, it could also surrender the losses by way of group relief, and again get relief at 19%. Or as we look to the future, as the rates in corporation tax rise up to 25%, you may want to consider whether it's more beneficial to carry that loss forward if it's likely that you're going to return to profitability in the future, as you then are getting relief at 25%. And so this is, whilst the rates were at 19%, there was not much variability in the options, and SMEs quite often prefer to have the immediate cash flow advantage of receiving the R&D losses as an immediate payable credit. So they would accept that they get slightly less relief for that, but the advantage of that is the cash flow boost that gives them. However, there comes a point now as we look to the rising rates up to 25%, the gulf that's then created between the immediate cash payment at 14.5% between relief at 25% becomes a lot more significant. And it'd be one for businesses to weigh up as to whether the relief that they're sacrificing is worth the immediate cash flow advantage, or whether it's actually cheaper to look at finance elsewhere and to utilize the losses by carrying it forward for future offset against future taxable profits. And this will vary from business to business depending on the stage of your life cycle, how likely it is you're going to return to profitability, and various other factors within your business in terms of how much sort of credit costs within your business, how cheaply you're able to access debt. These could all factor in the considerations of how to utilize losses. So there's not just one clear-cut option. Whilst many businesses do use the ability to receive the immediate cash repayment, it does come as a sacrifice, as the table at the bottom shows. So just looking at a loss surrender at 14.5%, based on a company that's incurring qualifying expenditure of 400,000, they would effectively be due back £133,000 under a loss surrender. If they had other profitable entities within the group, they could surrender that by group relief, or they could carry back that loss to a prior year and effectively get relief at 175,000. Or alternatively, looking to the future, if you were able to carry that loss forward and offset against future taxable profits, the benefit to the company would be 230,000. So it's in effect an additional £100,000 benefit for just carrying that loss forward and offsetting it against profits arising when the tax rates go up to 25%. So definitely one to consider that now we've got a rate rise on the horizon, and just something for businesses to bear in mind as they are preparing claims and looking how to utilize the R&D expenditure credit going forward. So that was just a brief overview of the R&D scheme. I know many businesses have been claiming this for a number of years now. I'm quite familiar with how it works. But if you do have any questions on that, please just do reach out to me in the chat box or at the end. We'll now just look at some of the key changes to the R&D tax regime that have been announced in recent months. So firstly, one of the main things that's been announced that's effective from the 1st of April 21 is the Paye Cap. And the Paye Cap limits the amount of tax credit a company can receive, and it's restricted to £20,000 plus 3 times the company's PAYE and NIC for the accounting period. And so that can be quite restrictive for businesses that either have a small staff base that subcontracts a lot of their R&D work, or it could just be businesses within typical sectors, including software and construction, as we see these having very heavy reliance on subcontractor payments within their claim. So anyone that receives a credit of less than £20,000, that they would not have to consider the cap, because this would effectively fall below the de minimis of £20,000. So even if you've got no PAYE or NIC costs, you get a £20,000 buffer anyway. So it's only those who are looking at the larger claims over £20,000. And it's mainly going to affect those, as we said, who have either low PAYE costs, low staff costs within their claim, and higher subcontractor costs. There is an exemption where the cap doesn't apply if the company's employees are creating or preparing to create IP, and it does not spend more than 15% of its qualifying expenditure on subcontracting or using employees of connected persons. So if that exemption applies to business, you don't need to consider the PAYE cap any further. So just taking a look at the example of how the PAYE cap works. So in this example, we've got 2 companies. We've got Staffco and Subco. Staffco employs its own staff in undertaking R&D activity. Subco, on the other hand, employs subcontractors with a few of its own internal staff. So each company makes a claim involving qualifying expenditure of £400,000. The the maximum tax credit each company could effectively claim is 133,000 under the SME scheme. Staffco has annual PAYE and NICs of £40,000, so its cap would then be 140,000, which is in excess of its claim. So that means then it could surrender the full amount of its enhanced deduction for the repayable credit of 133,000. Subco, on the other hand, only has £15,000 of annual PAYE and NIC, so its PAYE cap is then £65,000. So its payable tax credit is then restricted to £65,000. The remaining amount isn't lost. It just means that you can't surrender any amount above any amount of the losses that would give rise to a claim above 65,000. So the remaining amount that isn't surrendered is then just added to the losses carried forward. So you see the difference in the two companies' losses carried forward. The Staffco had total losses of £1 million. It surrendered 920,000 for the repayable credit, which gave it £80,000 of losses carried forward. Subco again has the same situation, £1 million worth of losses. However, its losses carried forward is 552,000 because it's not been able to surrender the full amount of the 920. So it would then get relief for those losses in future years should it return to profitability. And further announcements that was made in the budget at the end of 2021 was that the government's really looking to change the R&D regime to really improve its sort of generosity and increase the inclusion of certain costs, but it also came with some restrictions as well. So there was inclusion of cloud computing and data set costs, where these have been incurred as part of an R&D project. Again, this is more going to be relevant to those that are engaging in some form of technological R&D within so early stage tech companies, fintech companies. Those are likely to have significant cloud computing costs, which may form part of their claim going forward. Companies that were including undertaking advances in mathematical advances, and this now has the inclusion of pure math sciences, and this is particularly relevant to those within the AI space, robotics, those types of industries where there's significant elements of R&D work going into the applicability of math advances into their activities. So the costs that they incur in relation to those activities can now be claimed, whereas previously they were restricted. And then finally, there's going to be restrictions on what can be claimed for overseas activities. The government's main approach to this is it's looking to refocus innovation onto UK shores and not looking to reward companies for outsourcing that to third-party providers in overseas jurisdictions. There are some limited exemptions that may apply, but these will need to be assessed on a case-by-case basis. Just touching in a bit more detail then, in terms of the data and cloud costs, this can, from April 23, include the payments of license fees for access to data sets. This is only data sets that are used solely for R&D and not to be resold. So it can't be that you're reselling or further licensing the data set to someone else. It can also include internal staff costs to create your own data set as part of your R&D work. So this will now form part of the qualifying activity of a project. In addition, the inclusion of cloud computing and cloud software costs, this could be involved that's in the computation and data processing and the storage of data and the hosting that in the cloud as part of an R&D activity. So again, one really focused on tech companies and sort of increasing the incentive for tech companies to locate to the UK to take advantage of the UK R&D regime. Looking at now the refocusing of our R&D towards UK innovation. So the key points here are where companies subcontract R&D to a third party, these costs will only be claimable in the future if that third party performs the work in the UK. So maybe an overseas company, but it might do the activity in the UK, that will still be allowed. And similarly, where you're using externally provided workers, they will need to be paid through UK payroll. So in essence, those businesses that are subcontracted or agency providers for externally provided workers, they may be overseas, but they can be claimed if the activity is performed in the UK. If those companies or agencies are not performing the activity in the UK, then these claims will be restricted going forward. So this could significantly reduce the R&D tax credit claims for some businesses where this applies. And it'd be one for you to assess internally in terms of what makes up your cost base, or do speak to us in terms of looking at how this is going to apply on your claims going forward. It may be that there is elements of restructuring that could be done in terms of how you undertake R&D, but you'll have to weigh up whether the cost of restructuring is worth the additional benefit that this will bring. And finally, one of the key general announcements from the budget last year in terms of how our R&D is going to be improved and updated going forward is in response to just growing pressure on Hmrc from the government over concerns of abuse and boundary pushing of R&D tax reliefs within the industry. Hmrc have estimated that it's about £330 million worth of R&D claims are subject to abuse and shouldn't be claimed. However, it's the government are sceptical on that figure and I think it's actually much higher than that. So there is a general environment of concern over R&D being used to abuse claims and to effectively extract money of which companies are not entitled to. And this then comes with it further compliance burdens on businesses making claims. However, these are just generally welcomed by the profession and by tax advisors generally, as it's seen as measures which will only improve and legitimize claims and make them more robust. It's in essence some plans that will make claims clearer to Hmrc in terms of what's being claimed and the applicability of the R&D regime to these claims. And for those businesses that we do undertake R&D claims for, this shouldn't really present a concern. However, there are some sort of issues with some of the plans. So Hmrc are looking to make all claims to be made digital. This isn't necessarily a particular issue. However, they do cite that digital claims are going to require more details, but we're not exactly clear as what that will entail yet. Each claim will need to be approved by a senior officer of the company. This is something we do routinely anyway, so all our R&D reports are signed off by a director or someone within the company who's appropriate to sign that off. So again, this shouldn't really present an issue for legitimate claims. Claims will also need to include details of the agent who has advised the claims, and all the claims that we do are on our letterhead as well. I think this is just a policy measure to really give Hmrc the details of advisors who are perhaps more unscrupulous and making claims which are pushing the boundaries in terms of what is considered R&D, and they can then use that as a means of tackling certain claims more aggressively than from other advisors. So again, sensible policy measures really that should be put in place anyway. However, one of the issues with one of the measures is that companies will need to inform Hmrc in advance that they plan to make a claim. And this can be difficult for businesses that perhaps don't realize that they're undertaking some qualifying R&D activity. So they might be undertaking R&D activity, but not actually realize what they've done would qualify. And if they hadn't notified Hmrc, they may not be able to make the claim. We don't know yet whether this is going to be on a project by project basis or just whether a company needs to make an indication at the start of the year that the next corporation tax return will include an R&D claim yet. We don't yet know what the requirements will be, but that could be a particular stumbling block for businesses if they aren't proactive in terms of their R&D assessments for each year. And now with this, in the environment of abuse and compliance, what we're seeing is Hmrc step up measures to really look at claims. So we're seeing an increase in fraud investigations. So that's Hmrc actually undertaking more serious inquiries in that they expect or have an indication that fraud has been undertaken. So this is putting claims potentially in the light of criminal investigation and something that should not be taken lightly. So we have seen an increase in number of claims, a number of inquiries that have led to fraud investigations in the market. We've seen the notifications that have come from Hmrc about this, and we're seeing the convictions as well that have come through in the press of businesses that have been involved in this type of activity. So there's a real effort for Hmrc to stamp out on claims. But we're seeing them use the fraud investigation powers to target a range of claims, so not just particularly high value ones, but also smaller SME claims as well. So it is just to reiterate the point that going forward, the R&D really needs to be focused on meeting the definition of the eligibility criteria and making sure that the claims are being prepared by competent professionals and competent advisors to advise on what is qualifying R&D and what is not. And in general, Hmrc have stepped up the number of inquiries across R&D, and we've seen them increase their internal team to be able to deal with the higher volume of inquiries. So we expect to see that more clients, not necessarily more clients, more companies are facing questions from Hmrc around their R&D claims. As yet, none of our clients have received inquiries into their claims. So it's not something that we think is going to affect our clients, but it's something that could just be form part of claims prepared generally within the industry. So just moving on now, just to look at the Hmrc inquiries in more detail. We'll just look at just broadly about the landscape, touching on and expanding from what we just discussed. The inquiry landscape, as I said, is really becoming a more aggressive from Hmrc's point. They are scaling up their inquiry team. The number of heads involved in the team is expected to double over the next years, which means that we're expecting to see a larger number of claims brought into inquiry. Whether that's just initial questions, whether that is a full-scale inquiry into the detail, will vary on a case-by-case basis depending on what's being claimed. But there is just a general willingness from Hmrc to pursue inquiries where it thinks it has the advantage through to courts as well. And we've seen a number of specific R&D cases taken to the first-tier tribunals with mixed results for Hmrc, but certainly some key learning points coming out of these cases as well. One of the key things to note for businesses with the increase in inquiries that claims may be facing is that companies need to be ensuring that they keep proper records documenting their R&D. And this is becoming more and more important in light of the general themes that we're seeing from Hmrc. And so this is that the businesses generally just should be retaining and cataloging documentary evidence. So when your R&D processes are being undertaken, that there's suitable documents in place documenting what's being done, the processes that are being followed, the analysis and review points that are being undertaken, notes from project meetings, general timelines, the Gantt charts, all these things that you put in place as part of your R&D project should be retained and catalogued so that it can be provided to Hmrc just to evidence what activity has actually been done. As we make the assertions within our report that states that the company meets the relevant eligibility criteria, that it's undertaking qualifying activity, it's resolving technological uncertainty. But Hmrc asks for evidence of how the business has actually done that, and that's where this evidence will come in. So keeping track of this and making sure that you've got first-hand evidence to support a claim is key should a claim get selected for inquiry. Now, one of the key areas for Hmrc at the moment is around the issue of subcontracted and subsidized R&D. So if you remember right at the beginning when we spoke about the two schemes, you've got the very generous SME scheme and the slightly less generous RDEC scheme. And I mentioned that SMEs can get pulled into the RDEC if they are undertaking what is in essence funded R&D, so that their R&D activity is actually being covered either by a customer or through a subcontract arrangement, or it's being subsidized in some way by a customer as part of a customer contract. And the reason this is because a hot topic is that it's a particularly complex area. So businesses and Hmrc have seen that there's a number of claims where businesses have got this wrong, and as a result, a claim which has been claimed under the SME scheme it should have actually been claimed under the far less generous RDEC, as it's actually been they've been undertaking funded R&D. So there's a number of cases where this has gone through the courts recently, and we'll just take a brief look at some of these cases to see what the outcome of that was. So the first and one that Hmrc cites a lot in a number of inquiry letters is in relation to Paye Engineering. And this is one where they were successful at the first tier tribunal. As it's only the first tier tribunal, it doesn't set a legal precedent, and it's based on very specific facts in what the company was doing. So it has limited applicability to general cases, although Hmrc do like to cite this case a lot. However, where they have cited it in the following case, which we'll discuss after this, you'll see that it was actually dismissed by the judges and not being particularly relevant in that case. So, and I think that stems from the fact of just the specific nature of what the company was doing. But what comes out of this case is that it just showed the approach that Hmrc took to this. So they initially raised the inquiry and reviewed the invoices and contracts of Paye Engineering. And the contract showed that Paye had been paid for development work by the client and effectively been subcontracted to undertake R&D. And what this meant in essence was that they had not borne the risk on the R&D project. They were in effect undertaking R&D for their customers, and then the qualifying costs were then not eligible under the SME scheme, which they had claimed. So what this means is that companies need to consider where it is engaging with customers, and it is perhaps there's a sort of a fine line between where R&D takes place by a company for the enhancement of its own internal capabilities to deliver a contract, and where it's delivering a contract where the benefits of the R&D pass to the customer, and that's where the position can swing from falling within an RDEC claim or to falling within the SME scheme. So if you've got a contract with a customer and the customer pays you to produce a product to a certain specification, and that's all they're bothered about, and you behind the scenes are undertaking some R&D to make that process more efficient, so that you can perhaps maximize your margin going forward on future contracts, you're in that sense bearing the risk of the R&D. If it doesn't work, you've incurred additional costs which you're not going to get funded for, and you'll also bear the upside if it is successful and you're able to make your processing more efficient going forward. This would then fall within an SME claim for the R&D activity. However, if the contract was where the customer was paying you to perform the work under a contract, irrespective of the outcome, so whether it produced the product or not, they were just paying you for your time to develop something, and in the end it didn't work, but you still got paid, Hmrc would argue that that's actually funded R&D and you've been contracted to undertake that R&D, and therefore shouldn't be able to claim under the SME scheme. So it's really important that where your R&D centers around an element of developing a product for a commercial use, that your contracts are reviewed to ensure that it specifies who bears the risk. Avoid putting in place generic and templated contracts, which may not really fully explain the position, and ensure that you've got suitable, competent professionals within your business who can explain and elaborate where you have certain contracts in place. Because if you are wanting to vary your position from what the contracts say, so if the contract said one thing but the actual facts of it was completely different, you'll be relying on your competent professional to be able to explain the differences and why that's the case. And this may be critical to a claim that you're trying to put through under the SME scheme. And then the other thing to bear in mind is if you are putting a competent professional within your R&D claim, that they are comfortable in defending the claim with Hmrc should that go to an inquiry, as in a number of cases, not just the Hayley engineering, the competent professional has been brought under scrutiny. So this is a key person within an R&D claim, and it's one just to make sure you're selecting the appropriate person when you're undertaking the R&D claim preparation exercise. And now looking at a further case, a case in relation to Quinn, a building company, a construction company that followed the Hayley engineering case. This is one where the taxpayer was actually successful. Again, this only went to the first tier tribunal, so again, it's not a legal precedent. And in this case, Hmrc were arguing that the activities that were being undertaken were part of a project to deliver goods and services to a client, and that in effect they were being funded to undertake the R&D. But where this case differed from Hayley engineering was the fact that the contracts were for a fixed price. They were in relation to the delivery of a product, not for paying for Quinn's time or delivery to undertake R&D. The R&D that took place and the IP that resulted from the R&D activity remained with Quinn. It did not pass to the customer. The payments that they received on an interim basis for their construction contract were based on sort of the value which Quinn had provided to the client, as is typical on construction contracts, and not necessarily on the work performed or the costs that Quinn has incurred. So the R&D activity that was being undertaken by Quinn in the background, the risk associated with that was being borne by Quinn. And ultimately, the client was not interested in the R&D that was being taken place. They were not interested in the approach and the ability of Quinn to resolve any sort of uncertainties to deliver the contract. They just wanted the ultimate fulfillment of the contract, and it was Quinn that was undertaking the R&D on its own behalf in the background. And so you can see the sort of slight differences in these two cases, which evidence the discrete differences between what can fall within an SME claim and what can fall within an RDEC claim. And some of the judge's comments in relation to this case were quite sort of reassuring in terms of what we would hope would be the approach that's taken in relation to R&D claims. And they just commented that if Hmrc's approach was adopted, it would actually mean that the only time in which R&D could be claimed under the SME scheme, where there's actually no prospect for commercial gain, and that's not what the scheme is meant for at all. Of course, businesses which are undertaking R&D are hopefully doing so with the idea of exploiting that in the future, as that's the entrepreneurial intent for undertaking R&D for future investment. And so Hmrc's approach was actually going against that in this case. And it's interesting that the judge thought to highlight that. And now just looking to patent boxing, it's something that's just worth mentioning, as generally it sort of goes hand in hand with R&D for companies that have been undertaking R&D, may also be developing patents as part of their IP management. And just to look at where this fits in within a business's life cycle. So if we take a look at a typical innovation life cycle, right at the start, a business is undertaking R&D investment. And during this time, it's particularly going through a loss-making position, as its costs far outweigh its ability to generate any revenue from this activity. And the government has put in place the R&D tax credit regime to provide some extra support for businesses that are investing in this type of activity through the R&D tax credit claim, as we discussed. That effectively offsets an element of the company's investment within R&D through the tax credit regime. Now, over time, it would be hoped that the R&D is leading to an increase in profitability. And when the time comes that the profitability of the company exceeds what's being spent on R&D, and it's resulting in corporation tax being due, potentially those profits are going to be subject to tax of 25%. Now, the R&D activity may have dwindled, it may have stopped, the R&D project may be complete, or it may just be going through a maintenance phase of where the IP is just maintained at a certain level to enable the company to exploit it sufficiently. So there might be a limited R&D claim that could be made at this point. And this is where Patent Box then comes in. Because as you can see now, as we look, Patent Box there comes in to limit the corporation tax rate to an effective rate at 10%. So if you are a business that is undertaking R&D, which could lead to the patentable technology, actually applying for patents now and getting it in place early could provide that additional tax relief at the future point in time when the IP is likely to lead to profitability within the company, and really provide a significant tax saving going forward. So just a brief overview of what the Patent Box regime is. It effectively gives a 10% corporation tax rate on relevant IP profits. So that's profits generated from the exploitation of qualifying patents. The Patent Box is relevant if your company is paying UK corporation tax. You've developed an innovative product or process, you filed a patent application, and you're looking to generate profits from that. You can qualify if you've got UK or EU or some other international patents, or with an exclusive UK license. It can include all worldwide IP profits. So that's if you sell your product worldwide, and that product derives some of its value from the exploitation of IP, then that income can also fall within the Patent Box regime. And it's also possible to backdate claims from the patent pending phase. So once the patent has been granted, you can then go and backdate any profits that were derived through the patent pending phase as well. So briefly, just what is a patent? What can be patented? Patents need to be novel. It needs to be something new and not made public anywhere in the world. So if this is something that you are undertaking, and you are undertaking novel, innovative development, make sure that this isn't sort of forming part of the any sort of marketing material or seminars or journal publications that you're perhaps sort of putting this information out into the public domain, which would prejudice a patent application. The patent needs to be inventive, so not an obvious change to something already existing. It needs to be something new and innovative, and it needs to have some form of industrial applicability, something that can either be made or used, or an improved method of doing something. There are a number of things which can't be patented, which is sort of around literary and artistic work, certain ways of doing businesses, or ways of thinking can't be patented, certain methods of medical treatments, and various other things that can't be. But if you're undertaking some form of R&D, that there could be an element of the work that you've undertaken that could be patented, and it's worth sort of then bearing in mind whether you wish to pursue a patent application for those future benefits going forward. So just looking at a very sort of rough example here, you've got a company, Patent Co. It's got one patent in existence. It generates turnover of 10 million. 8 million of that actually relates to the exploitation of the patent. It's got expenses of 6 million, and 1 million of those expenses relate to qualifying R&D activity. So if you're looking at a company that decides not to make the patent box election, its net profit is 4 million. It would then have the R&D enhanced deduction of an additional 1.3 million. So its taxable profit would be 2.7 million, of which corporation tax would be due on that of 513,000. Now, if the company were to make a patent box election, there's a number of steps that they need to go through. So firstly, they need to split out their IP income, which is the 8 million of the 10 million. You then need to attribute the IP costs, which relate to that, which we're saying here in this example is 5 of the 6 million, which then gives sort of patented profits of 3 million. From that, you need to deduct a routine return. And so this is an element of the cost base from which there's a notional return which relates to what the company would expect to make just on those costs in general. And so in this example, we just assumed it's on the full IP costs. There are certain costs which don't need to be considered when you're considering what falls within the notional return markup. But for simplicity, we just used the full 5 million. So in essence, 10% of that would be a reduction of a reduction to the patented profits of 500,000. You then need to deduct a marketing return. So this is in essence the element of the patented profits which relate to the brand and intangibles, the marketing intangibles of the company. Now, for many businesses, the value of their marketing IP can vary. So it's for those which are perhaps not in sort of customer focused or consumer focused industries, that their IP, the brand IP, might be very limited. So there may actually be no marketing return adjustment that's needed. So we've assumed that in this case. Then you need to make an apportionment of the Nexus Fraction. So the Nexus Fraction is just a way of making sure that the patent box selection is aligned to the undertaking of R&D activity. So where a company undertakes the R&D activity in-house, in the same company that's making the patent box claim, it's likely that the Nexus Fraction would be 1, which means that there's no adjustment to the IP profits. So after you get to the end of those steps, the relevant IP profits come to 2.5 million. And then the patent box deduction is calculated as the formula shown. So the main rate of corporation tax less the patent box rate over the main rate of corporation tax multiplied by the relevant IP profits. That would then give a deduction of 1.22 million to the taxable profit. And that then reduces the corporation tax rate down to 285,000. So just on this example alone, in this case, it presents significant corporation tax saving. But if we also then look to the future rate rises, once the rates go up to 25%, you can see then that the tax saving increases a lot further, whilst the overall corporation tax goes up from 285,000 to 300,000. If you hadn't made the patent box election, your corporation tax would be 675,000 on the 2.7 million. So the saving then increases to £375,000. So incredibly valuable to businesses that are looking to the future, looking to that future profitability and looking at how they can minimize the corporation tax bill once the benefits of the R&D tax credits start to wind down. So just then to summarize what we discussed, we're just giving an overview of what are R&D tax credits. So for an SME scheme, a very generous scheme that provides a payable credit of up to 33% of qualifying R&D expenditure. SMEs may also need to consider the RDEC route where their R&D activity is considered to be funded, whether it's subcontracted or through grant income, and may need to also consider how they utilize R&D enhanced expenditure going forward, and whether they look to carry that forward to offset against future profits at the increased rate of corporation tax. The number of changes coming to the R&D regime, including the Paye Cap, which may restrict some claims going forward. There's potential increases to the RDEC rate to make it more attractive. There's also additional relief that's coming in the way of cloud computing and costs relating to advances in pure mathematics. However, there are also restrictions relating to overseas costs which are likely to come into play. So businesses need to prepare for this changing landscape. In terms of Hmrc inquiries, as we said, that there's increase in scrutiny from Hmrc, and businesses need to ensure that they're preparing robust claims that can be supported and are well documented. And finally, so once you are approaching the end of your R&D and innovation lifecycle, consider whether it's appropriate to start making patent applications now, as these often take 18 months to 2 years to come through, which would leave you well placed to then have a granted patent in time for the rising corporation tax rates that are coming into 25%, and Patent Box would provide that enhanced deduction to create an effective tax rate of 10% on patentable profits. So that's everything that I wanted to cover off in terms of the R&D update. I'm now going to hand over to Byron, who's going to discuss IP funding from Lombard Technology Services.
Thanks very much, Dominic. So I'm Byron Edwards. I work as a relationship director across the Northwest for Lombard. Now, Lombard are an asset funder, which may seem slightly unusual given that we're talking about intangible asset here. But essentially what we've done, we've had a technology specialism for quite a long time and recognised that a lot of technology these days, the value actually sits within the intellectual property that companies have developed from their own software. So I'll do a very quick run through of how this can work and kind of what we look for. And my contact details are on the screen now. So if you have any questions or you want to go any further, please do give me a call. I'm just conscious of time, so I'll try and keep this run through quick. But I'm available for calls or emails or for a follow-up meeting if anybody's interested. So if you could just move to the next slide, please, Dominic. So this is it's a little bit wordy, but this is essentially an overview of what we've done. We've taken the principles of asset finance, which is essentially leasing, hire purchase, all that, all of that, those type of stuff, which I'm sure you're all aware of. And we've applied those principles to software intellectual property that our customers have developed themselves. So at the minute, the funding applies only to software IP. We are looking at ways of bringing in other forms of intellectual property, but software is the most analogous to what we do. So essentially, it works the same way as asset finance. We take title to the asset, which in this case is the intangible asset of the software. We license it back to you as the customer over the period of the term. You have exclusive control. We don't interrupt. We don't want anything to do with it. So it's the same benefits as ownership within it, and you retain control of that. The big difference between that and lease funding is you get title back at the end, or you can get it at any time. So you always have an ability to get your title to your IP back. What this doesn't affect your ability to further develop the software or claim R&D tax credits, etc. We just saw that, as Dominic said, there's a really strong incentive in the UK for, especially in the tech arena, for R&D. The R&D regime is really strong to develop, but we then see that customers, because the asset is intangible, there's no real form of financing other than equity, and equity means you lose a bit of control of your business. This gives a debt option, so it's really an alternative to equity. Our customers use it to grow their business, to buy out initial investors, for an MBO, for growing the business in terms of investing more in development or sales and marketing, etc. But the key points are, you have that alternative to equity, so you retain control of your business. We don't take any control of the business. You retain control of the software. You can keep doing what you were doing. You can keep developing it. This has a lower cost of capital than equity. You've got the benefit of the NatWest Group, and within that you have the benefit of a relationship with one of the strongest banks in the tech sector. So we provide access to advice, events, range of banking services, and other products can support your business as it grows. So we have quite a good portfolio across that, and this gives you access to that as part of the NatWest Group also. Where the link to the R&D tax credits here is, we use that for valuation. The big difference here between tangible assets, which usually come with an invoice and so you can value them, and self-developed software IP is the valuation. So we look at, again, taking the tangible asset finance analogy, what's been spent on developing the asset, and that spend can be evidenced on almost a third-party basis using the R&D tax credits. So we look at what you've spent over the last 5 years, amortize some of the older spend, and that gives us what we call a collateral valuation, and we look, which is the maximum value that we'll look to fund, and then it just comes down to a credit call. This is a debt product, so we look at what level of debt you can service, and we take it from there. As I say, the key is you can either you can always get title back. You can also refund it as you keep developing your software. In a year or 2 years, if you've spent a lot more on it, we can refinance and put more money into your business. So it really is a form of flexible funding. Conscious of time, I'll leave it there, but happy to take any questions if anyone wants now, or please feel free to contact me by phone or email if you'd like to discuss it further. Back to you, Dominic.
Thank you very much for that, Byron. Yeah, it's just useful just touching on as what we said as well, just bearing in mind that the future rate rises going forward, that this may actually be a cheaper source of financing than surrendering your R&D tax credit for a payable credit. And so something that could be part of your consideration as looking for what to do with your R&D credits as well. So thank you very much for that. And if now I'll just turn to the chat. If anyone has any questions, please do put them on the chat board, or we can unmute you if there's anything you want to add. Alternatively, if you would like to contact me, my details are up on screen, and we can speak directly after this call or a future point in time if there's anything you do want to discuss. But I'd like to thank you all for joining today, and unless there are any questions, we will end it there. So I don't think we're getting any more questions. So thank you very much, everyone, and we'll see you next time. Certainly, yes, I will. I can send you a copy of the slides. We have your details from the registration. I'll be in touch after this ends to do so. So thank you very much, everyone, and do bear in mind that we have more events like this hosted throughout the year. So do check our website for further courses.